The fiscal year 2019 company earnings season would best be described as challenging. It was a weaker set of overall numbers, profit growth around 2.5%, so not much growth. The quality of those results was okay, so reasonable cash generation and return on investment by companies, but the outlook was quite subdued as well. And if we dig below that headline 2.5% type number, it was quite different across the core buckets or industries that we assess, individually. So if you look at the banking sector, for example, profit declines of about 7%, so particularly weak environment there and not much expected going into next year. Listed property trusts eked out a return of about 5%, so very solid. Resources were the star of the reporting season with earnings growth around 20%, so that's on much higher commodity prices. But in the industrial space, which is everything other than those three sectors, we saw about 1% profit growth. But digging into that again, domestic companies did it a lot tougher. So earnings for domestic industrials were down about 10%, and earnings for offshore industrials were up about 18%. So offshore industrials, very strong. When we look at what companies are saying about these results and what they're looking forward to, again, we're seeing quite subdued commentary. So earnings growth of about 7% is expected for next year. That stepped back from about 9.5% going into reporting season. We'd argue that there's a bit of risk to that. And again, if we took out resources, which again are expected to have another high year, then growth would be in the 2 to 3% range. So that we think that's more realistic. We think that's where we're starting from, and the likelihood is that maybe we see some downgrades come into that number as we progress through the year. So there are a few notable observations from reporting season. The first is that we're in a low growth environment. We got evidence of that. So 2.5% type profit growth is very low relative to recent years and for many years before that. The second is that boards and management teams are very cautious in their outlook statements. So they see a continuation of this lower growth environment. And if we dig into the reasons as to why that's the case, well, domestically, a very big sector in the domestic market is facing a bit of a downturn at the moment. That's really the construction and housing sectors. So building approvals have come back quite sharply in the last 6 to 9 months. Now we are seeing some signs of stabilisation in housing post the re-election of the coalition government and also post the RBA, a couple of RBA rate cuts, but it's early days and we don't know as to whether that's going to extrapolate into an actual uptrend. And that coupled with the next point, which is that the global environment is more challenged now. There are many geopolitical risks and macroeconomic risks at the moment. There's Brexit, there's the trade war, we're seeing trade volumes around the world effectively go to zero. So there's not a lot of reason to be optimistic. Potentially a resolution in the trade war might provide a bit of optimism. We'll see how that plays out. The other piece that is really noticeable through this reporting season is the premium that growth stocks are attracting relative to companies that don't have growth. And in a low interest rate, low growth world, we expect that's going to continue for some time. So those businesses that we can identify that have good structural growth drivers and are not going to be cyclically weak or low growth in aggregate should trade at a material premium in this type of environment. Pleasingly, the Australian Equities portfolio performed very strongly during reporting season with pretty much a flat result against a market that was down about 2.4%. And the drivers of that outperformance were largely individual stock selection. We have a diversified portfolio across a range of companies and sectors, but one of the call-outs was some of our bigger growth opportunity stocks that have structural growth drivers behind them. So companies the likes of CSL and ResMed in the healthcare space with large addressable markets and management team that is executing very well. We had a strong contribution from James Hardie, the building materials company that has a large exposure to the US. A new CEO in there is doing an excellent job on refocusing that business, taking some costs out. And we're getting a bit of a demand uptick with lower rates for US housing, so that's been a good contributor. Companies like Lovisa, our jewellery retailer that continues to roll out a very, very efficient and market-leading business model on a global journey. And then companies like EML Payments, our digital and virtual card payments business that is, again, expanding its opportunities offshore. Of course, we don't get everything right, and this reporting season we had a bit of a stumble with our remote telecommunications company in Speedcast. But by far and large, we got the bulk of the companies that were invested in right during this reporting season. We also saw a bit of volatility around a lot of results as well. Pleasingly, we were able to use a bit of cash and top up a range of positions that you'll see in your portfolios as you get your next reports. But we were able to be quite active in the month, and cash has come down from about 11% in the portfolio to about 6%. This low growth environment has translated directly over into a low profit growth outcome for companies. And in this low growth environment, there's a more subdued outlook for returns and equities. We're confident in our process. We've applied it consistently over a number of years to deliver returns above the index. And we think we're exceptionally well positioned to do that on a go-forward basis. So as always, at the forefront of our approach will be active management and individual stock selection.